All right, welcome back. Today we're going to be going over more of the real estate market instead of kind of the debt ceiling. We're going to pivot around the debt ceiling today. We're not going to talk too much about it. That's going to be the focal point of today's video. So if you have questions, we would look forward to answering those. So leave those comments down below. We're going to get right into it. So looking at, what's happening with mortgage rates, and a lot of people kind of assume like talking more about commercial. We're talking a little bit about residential. Everyone has this idea that residential is going to get smacked and kind of thrown around, but I personally don't think that's going to happen. And I think we're kind of on the same page with that as well. The biggest things that I'm looking forward to right now, the biggest things I'm watching are more towards commercial. And then I'm also interested in seeing if we're going to get any type of slowdown on or pullback on these residential rates. So residential rates 30-year, I think is at 6.4%. And then we have the new sleeping giant, which is are they 40-year mortgages or 45-year that they just released?
I think it's a 40-year mortgage.
Yeah, I think like it's a new curveball, 40-year mortgage.
That was a couple months ago, but it's supposed to go in effect in June.
So maybe your kids can pay your mortgage off. So that is the new wave of the future. So I know a lot of millennials are wondering how they'll ever be able to afford a home. There you have it, 40-year mortgages. That's just what we need. So that's where we'll get started off. I'll let Cajun's kind of been riled up to talk about this topic. So I'll let him start off. If you have any points you want to go over, and we'll kind of attack those.
Yeah, there's a couple. I guess we can start with commercial because it's something that we haven't really talked about that much in Discord because it was I guess when COVID happened, we had the big exodus of people leaving the office and going remote, and it's actually never really turned back around. So for us, it's just for the last couple of years, it's been kind of a constant, a new normal per se. But the real estate market was still very, very elevated, and comparables weren't there. So now you're seeing something, you know what I mean, that's worth talking about because it's the first time they've fallen since I think 2011.
I think it's really interesting to mention too before we like jump down the real estate kind of rabbit hole is that people keep saying too is like, compared to 2020 numbers and 2021, we need to realize also 2021 real estate numbers were like the highest they've been in like a long time. So like you're still talking about record breaking numbers when we start talking about 2021, 2020. That's when, price per square foot just shot up. A real statistic out there for you, fact check me if you need to. During 2021 at near, I believe, the middle going into summer, there were more real estate agents in America than there were homes for sale. So that definitely shows you the supply and demand issue that was there with homes. But it also, I want people to understand too, is like if we see a retracement maybe on some home values below 2021 levels, I mean, I'm just saying it's a drop in the bucket when it comes to actually retracing in value. So I just want to make that like kind of be known. So when we start mentioning maybe retracements in values and mortgage levels and what's happening with rates, that people just have a little bit of a understanding what was happening during that time as well. So I'll let you keep going. I just want to make sure like we kind of have that foundation.
Yeah, no, for sure. You're still like, I mean, at highs. It's just definitely an interesting topic, and I know your family's history on real estate, so I'm really kind of curious to get your take on it and what you're seeing in your market versus mine, which is going to be similar in the South. But it's I don't believe that we'll see commercial real estate rebound as quickly because I don't think that there's any reason for people to, I guess, take up office space outside. I guess the necessities in office space that I can see outside looking in would be healthcare, got to have an office. Lawyers, for the most part, have to have an office. Um, and outside of that, as far as small businesses, most of that's brick and mortar. But with the wave of e-commerce, that's definitely not going anywhere and only going to get bigger. I don't see an avenue for the businesses that allowed remote work for them to want to get just right back into it. I mean, not everybody's going to be Elon Musk where he wants to walk into the office. So I'm just kind of curious if now the Fed has to worry about the credit issues, so if we have the debt ceiling there, which you can touch on later, well, obviously we have a credit crunch with the banking issues. So it's going to be hard. The requirements to get a loan for a consumer or a business it's going to be it's going to be harder to get a loan. So with that said, what happens going forward, and then how does the commercial real estate industry change? And I mean, I'd like to hear your. I have some ways I could speculate around it, but I kind of like to hear your take on that.
So I think like what we've seen too, especially when we look at businesses in general. Like, so if we look at little tech commercial and residential, residential's I think it's a total different beast. Um, but when we look at commercial, I think the biggest thing, and I think businesses have painted a really clear picture of this of cutting cost, specifically employee cuts, laying off. I mean, the laying off of employees directly affects businesses and offices. It's a one-in-one connection. You know what I mean? Like that's if you're wondering if they're going to cut back on office space, look at the reduction of employees. You know what I mean? So we look at something like, what is it? I'm trying to think of a bank. I think it was Credit Suisse. They ended up getting rid of a third of their entire um a third of their entire company, which was pretty big. And then, you're seeing what's happening with Google laying off, we're seeing Meta and all these big tech companies. So I think that's really important to be able to understand and visualize what's happening there. And it's just a broad viewpoint of these companies got to this massive area of growth, which was 2020, 21. And then now we're moving to this area of we have high rates, which is like you said, companies aren't going to be able to get as many loans, get as many things along. It's going to cost is going up through the roof. And so they're just trying to pick areas where they can trim fat. And I think there's less need for workers overall, and which directly relates back to commercial real estate. Now, do I think the point of commercial real estate too that's interesting is I think it's more high tier, more like downtown Houston, New York, big cities. That's what I think in my head personally. Now, when it comes to commercial real estate, like maybe in a regular city, right? Like a small like shopping strips, and that's different. I think that's gonna be different. You're gonna see that hurt in the short term. I think it'll come back though. But I think when we look at large investments in those commercial real estate things, like we just talked about, that's the big issue. That's the big issue.
So a data point that's we can reference is 60% of all loans, and I can read you the quote. Excluding farms and residential properties, banks accounted for more than 60% of the 3.6 trillion in commercial real estate loans outstanding in the fourth quarter of 2022, with smaller institutions particularly exposed, according to the Federal Reserve semi-annual financial stability report that was published last Monday actually. So that's where I was going with the credit issues. If loans are going to be harder to get, the refinancing option isn't going to be as easily obtainable. So when you talk
100%.
about a debt restructure, that may not be in the cards for some of these companies that don't have the books to support it. So with that said, now you have an issue there. And for every one that would say default, and maybe they don't, you know what I mean? But for every one that has to figure out a new solution or go under, if they can't find the new solution, what happens there? Each time that would happen, you have a trickle down effect. And the real concern is, like you were alluding to earlier, we're still really elevated as far as prices and everything else. So what happens going forward whenever you actually have the correction in value? Because I can only assume, I don't know. I've read enough. It would be based on appraisal and based on comparables. And if nothing's selling, you have nothing. Your price just keeps dropping until it starts selling. But until you have enough of that, you don't have a correction in the market because you don't really have any new loan data coming in, or at least not at a rate that would be substantial and giving us any real input. So that's concerning as well as far as commercial real estate goes. The price will come down. Anything you read will tell you it's going to come down significantly. And you haven't even seen yet you're already seeing issues surrounding credit, and then potential smaller companies or banking issues that won't be able to allow a refinance option. And some of these banks might not even make it. And then who acquires them, and so on and so forth. And then, if a small bank has this real estate loan and they go under, well, you would have to, it'd be dependent on your loan, your contract with them, but you're going to be obligated to come up with that in a very short time.
Yeah, and actually, it's actually funny. Like Dave Ramsey has like a really like that's like if you ever like listen to like his story, Like he actually talks about that. Like he was like, I think he was like 23 or something. And I really don't like going on the Dave Ramsey trip, but he actually talks about that really often. About like he was like 23, 24. He had like 2 million in real estate. Knew a bank bought his bank that he was currently using, and then they made him basically say they kind of he got flagged and they wanted him to come with all the money at once. And so and he says like that's when he had to file for bankruptcy and basically kind of restart. Anyways, good interesting viewpoint. Google it. It's a really quick video you can watch on YouTube. It's really interesting. So the problem with commercial real estate as far as tracking data is it's not as easy to track as residential. Like residential, I can go on my local whatever it is for Houston, it's HAR to look at, what's all the homes for sale properties. That's really easy. That part is like so simple. I can look at average price per square foot, what has sold over the past 12 months, 6 months, whatever I want to look at. That's really easy to see. And so when we look at residential, and again, I have to say this, I can say this only so much. We're kind of still in commercial. We'll go to residential in a sec, but commercial is going to be slower because you're looking at lease terms, you're looking at office space available, and it's going to come slower. And you're also have to worry about the reliability of who you're getting your information from, as far as of them not like I don't want to say cooking the books, but being transparent with how much space actually isn't being used. You know what I mean? That's actually vacant. And so when you look at that, I really that's why I don't go down the commercial real estate train. I think it's a major issue. I think that the market won't ever be the same as it was pre 2020 when it comes to commercial real estate for office spaces. I think it will never be the same.
I think it's a bigger issue on the issues that are in front of us as far as credit and banking goes right now.
I think it's a giant underlying issue. I think it's the giant underlying issue with these banks as well. I think we harp on, the banks made a really bad bet on, yields, terrible bet. But on top of that, they also were overextended into commercial real estate as well. So it's like there's definitely two coins there, but the position that got them to be called margin called, or that made all these, red flags and, ultimately put them out of business, was the yield. And so that's why we focus more on that, which was, a bonehead decision to buy those yields when they were literally printing you no money at all. But yeah, so I think commercial real estate, big problem. I think it's going to be a domino effect, though. I don't think it's just going to be like, we're not just going to see a commercial real estate crash, personally. You know what I mean? I think it's already happening. We're seeing it happening in more places than just here in America.
The transactions, I don't think you have enough transactions taking place for the actual correction to have happened yet. Nobody's buying it.
Yeah, well, yeah, no, 100%. There's no mass selling of it either. That's right. The thing. And so when you there's an issue, is you start seeing selling, because people have to get out of that position, or re-leverage out of it, or get into something else, or whatever it may be.
And I guess that's the biggest point, is like traditionally people would be able to restructure debt, refinance, leverage, and all those options may be going away, or maybe they may not go away, but they will be much harder to obtain. And Fed's concern.
and that's the problem too, is because we don't know. And that's going to be the hard part to see, of who did that structurally and maybe saw that coming in 2020. Because if you did it in 2020, when we started to see these issues, because I think the writing was on the wall but you didn't know what was going to happen to real estate in 2020. You really didn't understand what was going to happen to the economy and how it was going to shift so much to at-home work until like the end of 2021. Sure. So anyone that actually made the adjustment because if you did refinance from 2020 to 2021, you were set. I mean, you still got locked in at low rates. I mean, maybe you might have been with an unfortunate bank to where you might have to come up with that money or show evidence of that money to back that. But besides that, I think 2020, 2021, you could have said, but I'm going to say right now, I don't think anyone really predicted the state of what was going to happen. You know what I mean? Because these layoffs didn't start until mid 2022. Sure. You know what I mean? So until mid 2022, after everyone was like, a recession's not going to happen, we're going to stay fine, we'll stay, floating where we're at. And then we start to slowly see companies say, okay, well, our period of massive growth and innovation, it's time to hit the brakes and start focusing on trimming fat. That's why I keep saying too, with like tech names, I'm like, I I don't hate them, because if you look at what's happening with these tech names, is they've been in this period of spin, 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 grow, 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 take as much market share as possible. But now they're at the point, to the first time in, I would say, man, over 5 years, to where they actually have to start trimming, trimming fat. Where they have to, I'm going to trimming fat's probably gonna be the key word of the day, is because you're seeing them nitpick on areas where they can save money, or you know what I mean, that along those lines.
With that exact statement is trimming fat. What do you think banks are going to be doing? They're going to be trimming the fat.
Well, now it's more than ever. That's what we saw
right.
BlackRock. That's what we saw BlackRock do what they did.
Right.
And if you don't know, BlackRock just started loading up on longer term yields and rates. And it's funny that they're mentioning it, because now they're like it. And if this is a little bit off subject, but if you don't know, yields being this high are it's like the safest investment that there is. You just throw your money in and you're guaranteed 4 or 5%. It's awesome. Like, if you're a millionaire, you couldn't be happier.
But if you had one prior, you're losing.
Exactly. Which most of these banks did.
Right.
And then BlackRock doing this really highlights the fact of how valuable these are, and then points to the fact of how irresponsible some of these investments and by smaller banks were. So it's like a catch-22. But yeah, go on.
It is, but I mean, before we get off of commercial real estate, I guess it's something to bring back up. I mean, a while back you were talking about it pretty heavily about the balance sheet, and we saw the drastic increase in the balance sheet here recently. Well, that balance sheet went to what? To give banks the option.
Yeah,
to do what they need to do to sustain.
Well, it's important to realize too, only a third of that was like used. Well, let's say half of it was used. The other half is just sitting in these banks as free cash.
Oh, it is. But what I'm saying is, but they don't give it without the expectation to need it.
100%. Yes, 100%.
So with that said, with commercial real estate, you have the largest exposure there, second to the yields issue.
Yep.
Right?
100%. Yep.
So I guess what I mean is, it's there for a purpose, and this may be the purpose. So you have to keep that in mind going forward.
And it should be alarming, because I want to believe, as much as I want to be the biggest bull there is, I want to believe that the Fed just gave double the amount of, because basically, if you don't know, they used about 180 billion. I'm sorry.
Of the 370 or
something. It was like 320, I think 320 billion. So they used about half of it on, bailing out these specific banks, and then they gave around 40 billion of it away to the smaller banks to give them enough to make it through. Right now, you want to believe that they just overshot and gave an extra 150 billion for those extra banks, which is where you have to assume. But I don't personally believe that that's what, as you look at it more, you don't believe the Fed overshot $150 billion. You just don't. Because at any point in time, they've already said too, if they need to get more money, if they need to do more, they're going to. Specifically with banks, they're not going to let the big banks fail.
Which means, for what they look at, which is to my point, they felt like this is what was sufficient for the time being, and there's a chance that they could give more.
Exactly.
So, we can backtrack to, I think it was October, when Jamie Dimon started talking about how liquid they were, right?
Yep.
JP Morgan, by the way. So initially, I was talking about it heavily. You and I talked about it a good bit. It was looking at it from a perspective of the indecisiveness in the markets and not knowing how the Fed would handle this inflation fight and so on and so forth, right?
Yep.
But hindsight being 2020, as it always is, we're looking at it now, and JP Morgan was able to acquire and bail out themselves internally some of this. And realistically, I don't know what they've received from the Fed, but did he see the exposure that was there and plan that accordingly? And it wasn't necessarily as market driven as we might have thought it was. Was it a strategic move because of data points he had in the banking sector? I mean, they were 2 trillion liquid by December.
Well, you're pretty liquid across the board, though. I know Bank of America came out and said they were extremely liquid.
They came out almost 2 months after Diamond started saying so. So what
Yeah.
I'm saying is
Yeah.
we had to take it at the time as a market's perspective, right? And you could see the liquidity there, and then you start having liquidity in the bond market, issues in the bond market, and so on and so forth. But hindsight being 2020, it's awfully convenient, which is great that it happened. But the
Yeah.
big banks seem to absorb some of that shock, and the Fed, you know what I mean, put the money out there, and I'm sure it went to some of them as well. But obviously, there was underlying issues that forced them further than just, you know what I mean, market indecision to move into this. And was it, you know what I mean, a plan of attack on banks or commercial real estate, or even, I mean, for a while, how many houses was BlackRock scooping up for a while?
Yeah. No, that was the story of 2020 to 2021.
No, so what I
Yeah.
mean is, like, we have to look at it. You always have to look back. Same thing like with the trade. You always have to look back and say, where did I go right? Where did I go wrong? And then a theory is a theory until you can either disprove it or prove it, right? So in this, we had a theory. We speculated on that, but I mean, maybe it was just a matter of where the data we can see is so limited, and we're not directly involved in that sector, that here we are, right? So I think the Fed plans on using that. The Fed allocated the money that they felt was needed at the time, and then they made the statement that they will do more if they feel the need. Did they not need to do more because the big banks were set up to absorb it, which is great. It's a much better position than we were in a decade ago or 8 years ago. So it's just things to think about along that aspect too. And I think it directly goes to, you know what I mean, things like commercial real estate. And it might be why you see it as a not necessarily a dying industry, because it'll always be there and always have.
Yeah. I don't want, I definitely don't want it to come across as when I say it's not going to be the same ever as 2020.
No.
I don't mean it in that sense.
I don't think you've seen the
Yeah.
correction in it. I mean, some economists are calling for 15%. I think reality would be 8 to 10, and that's just off of what I can read over, you know what I mean, the months. So you haven't got there. That's not huge compared to where we've gone.
Exactly. And you have to also think to the sense of it, and I keep saying it, is when companies, and I think we ignore kind of this cycle of companies, right? And I think we saw a lot of it with 2020 and 2021 with Biden when he first came in. We saw companies, I'm trying to think of clean energy companies, but we saw First Solar, Enphase, what's the one that did carbon capture with the Exxon? I can't even think of all of them now. There's so many. But we saw what they do is when you get to market, you start just pumping out money, you try to grow, and you hire as many people as possible, and it's just all about growth. And we need to come to the realization that when you go into recessionary periods, it's about mitigating losses, surviving at that point off of what you have captured, and then moving on, you know, and hopefully making it to that next cycle. It's just over and over and over and over and over, right? So when we look at it from that viewpoint, I think you have to come to the realization that commercial real estate is the one area in this market that is getting the most affected because you're able to do half of the work that's out there online from your home and your computer.
Sure.
You are just, it's more than ever. I think 2020 just highlighted that. And so for the first time, there's a major cultural shock in commercial real estate, and the market wasn't prepared for it. It's, in my opinion, it's that simple. I think it's maybe oversimplifying it, but that's kind of where we're at. And then, so yeah, there's going to be a reality. There's going to be a shock to the market hitting commercial to where it starts dropping. But I want to make sure everyone knows when it comes to residential, I don't think that is in certain areas of America, it will happen. Okay. I'll say that. In a lot of America, I don't think it will. I don't think we see the pain.
I think you do. I don't think I don't think it's going to be seen like what people may expect things to be seen. I think the issue is borrowing rates are going to stay elevated. I think that the consumer can't doesn't have credit's overextended. It's proven. It's in the data.
Yep. I mean, I think interesting credit statistic of 2021, 2022 was the average American who buys a home. I think their credit increases by 30 to 35%. And that's a shocker because that was a snowball effect. And so we've seen credit rise on everything else, but not only if you buy a home, then your credit and your spending basically increases by 30%, which
Right.
majority of American spending is done via credit. So we need to understand that as well.
So I guess with that said, you know what I mean. Like you have more credit exposure these days for the consumer. You have a higher borrowing rate, and you're going to have loans that are harder to acquire for the banks. So with that, I think that's where you see the trickle down effect in housing. Now I think that's a slower effect than what we may see in the commercial real estate industry because people still need a place to live, and there's a lot of people in America that still believe the dream is to, you know what I mean, own a home and move on. So I don't know. I definitely think it's something you see everywhere. Maybe states like Texas that are doing a really good job.
That's what I'm saying. It's hard to housing markets are just they're their own little economies. So I can't compare, for instance, Texas to Washington D.C., the
Okay.
most expensive area that there is out there.
Like
Or
for example, I can read this off the Fred data. West Virginia added only 5 days to its median time on market from a year ago. So that's year. Everything I'm about to say is year over year.
yeah,
Okay. Ohio and Illinois added 6. Maine added 47 days. North Dakota 44. Vermont 43. This is just in a year over year basis, right? So places like Texas, it would actually surprise you that added 28 days.
no, 100%, and I've noticed it. I have noticed it.
Okay. Whereas a place like Louisiana, you're welcome to come here, by the way. You can move, bring all your stuff. It'd be awesome. Anyways, a place like Louisiana is at 15 days. So you're seeing it in places that are surprising. You're seeing it in Florida, which is over 20 days. You're seeing it in Texas, which is over 20 days. And those two, outside of the Disney hit that just happened to
It's
Florida,
the best, probably some of the best real estate markets in America.
but what I'm
Florida,
getting at is, and it's advantageous for people to want to move there. Yet you're seeing more time on the market in places like
yeah.
that, which we thought were places that would hold up longer.
So the factor that's happening there, and I've been watching it pretty big because if you don't know, basically, for anyone listening, Cajun knows, but my family, they basically just do real estate development, right? Primarily single family residential, some multifamily, but primarily single family. And so my dad has been on this mission, I call it, with Galveston, which is heavily beach homes and tourists. And I'm just like, dude, if there's any area in the Texas market that's gonna get hit, that is it. That is the definition. I don't but he said something to me that was interesting. And he was right to an extent. So you're having overall buyers, like, so let's say, for instance, like I'm gonna say this, I'm gonna compare Cajun as a small business owner. Cajun, let's say Cajun makes $300,000 a year. I don't know how much he makes, but let's say that's how much he makes, right? Small business owner, he makes 300,000. So he's like a above average American, I would say. So he's making his money and he's looking to buy a beach home or investment properties. Now that person typically wouldn't be buying a beach home with cash. They would still be getting, they would still be getting a rate on them, right? They'd still be having a mortgage on it, but they'd be trying to turn a profit via, vacations, Airbnb, whatever it may be. But the super wealthy, which I'm not saying Cajun's not wealthy, let's say there's another person that's super wealthy and they're multimillionaires and they're making over $1 million a year, and they're looking to buy property flat out for cash. There's a giant difference in the two people right there, because still buying the properties, they still have their value. They're still going to retain value over the next 5 years, and they're still going to retain the value from the Airbnb and the rental perspective over the next 5 years. And so what you're seeing happening specifically here in Texas is you saw a major slowdown, because if you're no matter what, it's usually better to use your debt when it comes to any of these properties. You want to use debt, or you want to use credit to have these properties. You want to have cash in hand as much as possible. But I mean, the advantage now is you're seeing some prices drop specifically on beach homes, vacation rentals, Airbnb type properties, things along those lines. They're dropping. Like, for instance, I would say it was going for around some houses, depending on beachfront, let's say second, third row, we're going over 350 a square foot in Texas. Now those have dropped to, like, let's say 280, maybe even 300. Let's say 280.
What were they
They were around 350 a square foot before. So that's a little bit over.
Pandemic. What were they?
Oh, pre-pandemic, they were even lower. They were like 200. It was crazy.
Yeah,
That's on
175, 200-ish.
So yeah, we just hit a spike. It was just because you saw what was happening, and there's this mentality in America. And I keep saying it. It's this Trump era and again, it's not me talking bad about Trump or people always get all twisted about it. I'm like, this mentality happened in 2020 or 2008, whenever Trump was elected, right? It was this spend, you deserve it, spend your money. And it got the economy working. That's why the economy did pretty well and why we bounced back from, what we should have had a recession in 2018, 2019. We bounced back so quick, right? That's why we did so well, is because everyone was spending. Now, you're seeing these people buy these homes just for cash straight out. And then what they're probably going to do is once rates drop, with the expectation that rates are going to drop, is they'll just refinance their properties and they'll just take the cash back out of them. Does that make sense? That's just typical renter 101. And then they start to do the cycle over again. That's like rental. That's like if you run rentals, that's like the formula. You get a property, you start, get your money into it. Once rates go down, you refinance, take the money out of it, reinvest it. The cycle of life with rentals. And so that's what you're kind of seeing here now. Now with the side of, single family residentials for, homesteads where people live, you saw a slowdown. You did, because I've been watching. You saw the slowdown, but then you saw people they just don't care now. They're just like, look, like I'm gonna pay this much in rent either way. I'm gonna pay $600 less, and I could just be using, or I could just live in a house, right? And it's interesting, and in areas like Texas are hard to relate to because, like for instance, the energy business isn't going to go out of. It's not going to slow down over the next 10 years probably. Like with Exxon and Conoco and these other, maybe you get some slowdown, but the way that
election always a slowdown, so you have that.
Yeah, so yeah, around that time, but with the likelihood of, I would say right now, a Republican president is looking more and more likely just based on factors out there right now. I mean, you hate to bet on it, but it is what it is. There's this expectation of, again, just continuing to do what you've been doing of spending beyond means, and it is what it is. So again, I think residential is simply put, far less in danger than commercial right now. Commercial, there's an immediate danger. In my single family residential, I'm looking at it, I'm like, dude, like it makes sense. Like I look at a rent, for instance, the newest apartments around me are the newest condos for rent. 2 bedrooms going for $2,700. I'm like, what? That is crazy. That's a house note. That is.
I could see commercial going back to lower than pre-pandemic levels. I don't see how.
I could see that.
I don't see residential getting. If it gets there, it's not going lower, in my opinion. I don't think it gets there.
Yeah. Nope.
Now, and with that said, I would like to use your state for a point and then have you rebuttal to that. So do you not think, or I'll rephrase, in Texas, you have, you get no income tax. You have much higher property tax.
It's tough.
Okay. And your homes are still severely elevated from where they were. They haven't fallen as drastically as I expected them to.
No.
So in Texas. All right. So with that said, you mentioned, you know what I mean? Some people are just like, oh, well, just give me a house because it's just a little bit more than what I'm paying for rent. At what point do you think people that really process information look and say, okay, I can pay $2,600 because I've looked in the Texas market because there's some interest there for some other things. But anyways, in the Texas market, I can get $2,600 would get me 33,000-ish square feet in Katy, Texas. You know what I mean? Decent neighborhood, not a brand new house, but 10 years old, 15 years old at most. All right. So that's what I'm going to pay, $2,600 for 3,000 square feet. Whereas to purchase it at the current rates, I'm going to be $3,000 minimum, right?
On top of their property taxes.
Well, property taxes built in, you'd be between $3,000 and $3,300, depending on.
Yeah,
if you can buy points on your loan or anything like that.
Yeah, I'll give a visual too, just so you understand property taxes and how serious those are right now.
It's 3% of the value.
It's tough. So like giving people just a number. So let's say you're paying about $2,600 in a note. You're paying around $600-ish on
But
most of
still,
these.
you're 60 something years old.
Yeah. So
So with that,
I want that to be just known. So
yeah.
it's almost like it's like a 25% of your note comes in again on top of that. So that's the tough part.
And then the way loans are structured for a house, you're not paying a flat interest. It's based off of principal owed
Yep.
annually. Anyways, so
Yep.
neither here nor there. But my point is, at what point do people really start processing this information and say, okay, if I'm going to go purchase a house that's 10 years old, at 10 years old, my AC is going to become an issue in the near future, likely. At 20 years old, I need a new roof. Neither one is getting cheaper. All right. So if I'm going to be paying an extra $13,000 to $15,000 on a $300,000 house that appreciated now I pay even more. But at what point do they look at it and say, okay, I make 100 grand a year. I don't pay income tax. Where if I went to Louisiana, I might pay 9%. That's $9,000. All right. So at what point do they say I can keep my 9,000 that I would have been paying in property tax, but if I rent and have a landlord, it's his AC, it's his roof, it's his issues. I pay utilities, I pay it, and I wait.
So I think it's a very interesting argument. And I agree from a logical point of view. Me and you, maybe 10% of viewers think that way. Again, that's why people like even me when I moved to where I live now.
I wouldn't say it in long term. I'd really like to kind of clarify that. I wouldn't say that's my until this new instance happened. I was believe, you know what I mean, invest in something, buy a house. It was a good plan, especially
No, yeah,
the rates we saw. I really did.
yeah,
You weren't going to get me to be a renter. It
yeah.
wasn't going to happen. Now it's like, okay, you have to look at all the avenues. That's why I'm more asking these questions. And because if people start kicking that around and process it, it is an avenue for them if they can afford it, but it also doesn't require them to have as much job stability. It requires them a little bit of freedom in case they need to move. You know what I mean? Like, so people start looking in that avenue, whereas if they're attached to something, they owe it. And that's it. So, is it an avenue for people in markets like Texas to say, you know what? Let me wait until I at least know that the interest rates aren't going to get higher and I have an avenue to refinance down the road. And those type of things in those type of markets could be a reason that you're seeing these these days on market drastically grow versus places like, you know what I mean, Louisiana, Arkansas, Georgia, et cetera. And that, I guess that's what I want your take on there.
I I think that most of the things with time on market, he's basically saying, just so you know, is the average time a house will stay on the market, right? In Texas, give you guys a visual too. 2021, early 2022, your homes were staying on the market for less than a week. I mean, I'm talking not, not grade A homes. I mean, they're just mid tier. People just wanted to buy a house because I mean, think about it too. You're working from home now. You want to have a nice place you're working at. You know what I mean? You don't want to be in an apartment or condo, whatever it may be. So that was the thing there. Now, when we look at growing time on market and the concerned residential, I totally am on the team of ignoring the logical viewpoint of consumers. And it might be a bad take. I just think that if you look at consumers, generally they're not thinking all the way through. I mean, take a look at car auto loans. I mean, what was happening during 2021, 2022? It was honestly, if you look at it, a terrible time to buy used cars. It was a terrible time. People were buying cars with terrible rates,
And now they're all upside down.
and now they're all upside down. They're taking 7-year car loans. So I'm like, what? So I think to rely, and it's again like you hate to like talk about investing and not taking the logical point of view or the logical point of attack. But when you look at it from that viewpoint, I'm like, I got to be careful from taking too much of a logical viewpoint
Yeah,
because
you're right. I mean, I
because
just kind of break down everything. I'm really analytical when it comes to that. It's like I kind of look at everything kind of like I look at a trade. And it's like, man, okay, have y'all not processed all of the information? I feel like a consumer is just steady on impulse. On impulse.
that is, I'm telling you, that is what our foundation of consumers has become over the past 5 to 6 years. That is the foundation of consumers.
I don't disagree with you. I guess what I mean though is at some point people are going to have to be free enough meaning that they have to have the availability and the flexibility to move at a moment's notice if we're going to be in what one day everyone will either agree or disagree that we entered a recession or are going to enter a recession. At that point, with the job loss, I mean, think about the job loss we could see in just the construction avenue. If the debt ceiling would default, instantly you're going to lose 1.5 million jobs. So
Yeah, it'll be bad. Yeah, you'll
manufacturing
see
and
that.
construction. So what I'm saying
Yeah.
is, like, if you're looking at things like that and be like, okay, I might have to relocate that way. You know what I mean? I'm available. I'm not going to you don't even have to be very logical to not attach yourself to something.
But then when you come back and you look at the savings rate in America, and then it points to the same idea of consumers do not care.
But
That's
but Fred data is 2 takeaways on mortgage rate data. The blue line, if you were to pull up the chart, is mortgage debt service payments as percent of disposable personal income. That is actually lower than it was in 2020.
so the question about that too has to be when you're looking at 2020, is it taking in data that's
I'm looking
one?
at currently. I'm saying it's
It's
just the same.
yeah, that's what I'm saying.
spot
I'm
it was
saying
in 2020.
is that data processing? Because
This is their last
yeah,
report.
yeah. So the question though about that is because people that bought homes between 2020 and 2021, you are set. You're happy.
And they had wage growth, so
That's what I'm saying. So wage growth is continuing to go up.
but you
So-
still had a massive influx of buying there. So with that said, if
But
disposable income metric is still pretty much flat,
Well, you saw
was what you're talking about enough to offset it?
So you didn't see the mortgage rates rise until like second quarter of 2022. You saw them slowly rising the first quarter, but the second quarter near summers where they start. I remember vividly because it got above 4%. People were like, "Well, this is getting interesting," because 3% was like that sweet spot where it sat at. So I'm saying if all that buying, which a majority of that residential buying was happening below 4%, in my opinion, and if you're sitting there, you're not too. Again, people think like, yeah, a house might be 500,000 and then it dropped. For instance, if I bought a home at 2.8% on a loan, like I think my dad, he was telling me the other day, I was sick to my stomach with how much he's like, I think his rate's like a 2.6. I'm just like, that is just gross. I'm like, what? That is crazy. So if you bought it at let's say 2.8, 3%, you bought a $500,000 house at 3%, giving you like just a quick calculation, like, dude, like it's actually disgusting. Like it really is.
Well, you would pay it in a 30 year or 15?
30 year.
Oh yeah,
30 year.
you probably pay like $1 million, 1.2 or 1.3 million dollars for the same house.
I'm just trying to get the number on the what your note would be. Just not even with taxes or anything. Just a loan. Let me go down. I have the calculator right here. I've brought up. One sec. So let's say you put 3%.
6.4.
Huh?
At the median right now, which is 6.4.
Exactly. So you're paying your note's almost double now on a $500,000. Like that's the part that we have to talk about.
If you buy in Texas, you still got property tax.
Yeah. So So let's say you buy a house at $500,000. You put 10% down, which I would never, unless you have a lot of equity built up, but you can't go FHA. So let's say at right now 6.4% on a $500,000 house, you put 10% on 50K, so it's 450 what you have left on your note. Your rate's going to be around 2,812, right? 2,800 roughly. Now, let's say you bought the same house, okay? Let's say you bought the same house back in 2020, whatever, at 3%. We'll do 3% flat, right? That note goes down to $1,900 at 500K. So let's play the game and say you're going to still put down 10%, but home values, let's say this home dropped down to $420,000. Let's just hypothetically. You lost, what is that? Roughly 20% of the value around. At 6.4%, you're still paying $2,400 almost. So you're paying almost $500 more, even though the value of your home has dropped. And so that's what I'm saying. When people start viewing the value of your homes and that's what's dictating whether the market's going to crash or not, I'm like, guys, look, that's why when you pull up that chart and it shows you how much exposable income you're putting on it, I'm like, it's hard to relate because people's incomes are still slowly rising. Yeah, inflation's hurting them in other areas, but on the area of house inflation and what's happening there, it's not that bad. You know what I mean? And so that's what I'm saying. It's hard to track exactly the big problem.
Now,
And if you're locked in below 3.5%, I think you got to be happy unless you got ARMs or anything like that.
yeah, I agree with that. Now, I will say to that point of disposable income that available in 2019 was the first time it went lower than. So the data's been recorded on Fred for, I think it's like 19. Let's call it 1980. I think it was a little bit before that.
It's like 1970 something. Yeah. I have it up.
So, anyways, in 2019, 18 and 19 was the first time disposable income was at made a new all-time low. And it is still below that metric. So since they've recorded it, since 2018, the amount of disposable income available to put towards this is at lows and has stayed at lows.
And again, it makes sense that when did that happen? 2019, 2020, because we're in this area of pushing, spending. That's what I'm saying.
Yeah,
and we also have to know too, it's incredibly hard to foreclose on your homestead. Like that's a whole nother conversation. And foreclosing on commercial real estate, incredibly easy in comparison. It's totally, I mean, it's like comparing the bar to becoming a chiropractor. It's like, I don't know. It's like one's a heart surgeon and one's like your local, I don't know, like natural doctor telling you what vitamins to take. I'm just saying, like, it's totally different, totally different. So that's a really big metric to take in there. We're going to almost wrap it up. Some final closing thoughts here. Anything else? I just want to make sure we kind of covered all of it. I know this is a pretty big subject people wanted to hear about.
Yeah, you and I could probably go on for hours on this.
Yeah, this is like, it's definitely one. You're probably going to have to, man. I saw all the flow you put in there, but yeah, and this is, again, on that chart you sent, like, I think I sent it this morning too, is you're finally seeing those commercial real estate prices start to drop.
Yeah.
And chances are it's like, once you drop, it's not going to be a slow period. It's going to be a drawn out period, because once you start seeing the value start to drop is when you start to see the snowball effect.
Yeah.
Because then you start saying, well, if someone's selling it for cheaper and someone else is hurting, then they have to kind of undercut them or try to get out for even less. And then you start seeing buyers become stingy. And that's where this term buyer's market versus seller's market is really, this becomes a buyer's market, because buyers get to pick and choose what they want to get.
I would agree. And the thing we haven't seen, and it's one thing to watch, especially in the commercial sector, is you know what I mean, banks forcing people out.
Yep. No,
So
I agree. I agree.
That's a bit, even not with a default, like, hey, we don't want to be exposed to this anymore. You know what I mean? And forcing it. So it's definitely something to watch, and along with everything else that's going on in the market. But I definitely enjoy this topic and could go on forever.
Yeah, we're probably gonna have to. If you have comments, leave them down below. We'll try to attack the comments more on the next time we cover the subject. Probably a week or two before we come back to the real estate. But that'll be the focus of probably maybe the third episode after this one, or the second. But like, subscribe, do what you gotta do. We'll see you next time.